Welcome everyone. Let me start with something that might surprise you. PE ratios don't matter. At least, not the way most people think. Because what really drives long-term returns isn't the multiple you pay, it's the return the business earns on its capital, and whether it can keep reinvesting at those same high rates. If a company earns 20% on the capital it uses, each dollar makes 20 cents. If it reinvests those 20 cents at 20% again, the base gets bigger. 1 becomes 120, then 144, then 173, year after year. That's compounding, and it's why the best companies run far ahead of the average. This isn't just theory, it's practice. The most reliable market beaters follow exactly this philosophy. Let's see what Warren Buffett has to say about it.
The ideal business is one that earns very high returns on capital and can keep using lots of capital at those high returns. I mean, that becomes a compounding machine. So if you have your choice, if you could put $100 million into a business that earns 20% on that capital, say 20 million, ideally it would be able to earn 20% on 120 million the following year and 144 million the following year and so on. That you could keep redeploying capital at these same returns over time.
We see that Warren Buffett is a classic example of an investor that has outperformed the market over a long period of time with exactly this strategy. Legendary investor Terry Smith has outperformed the market consistently over a long period of time as well. Since inception, FundSmith is up 603.4%. Annualized about 14.1%, and as a comparison, global equities about 11.9%. Decades of proof that quality compounds. Let's hear directly from Terry Smith to explain why buying high-return businesses is the way to go.
Why is this important? Companies are just like us. People will overcomplicate analysis. Companies have a cost of capital and a return on capital. If they make a return above their cost of capital consistently, then the value of the company grows over time. If they make a return below their cost of capital consistently, the value shrinks over time. Think of it in personal terms. If you go out to your bank and borrow money at 5% and you invested in FundSmith for the last decade at 18%, you would have become more wealthy. Right? If you borrow from your bank at 5% and invested in somebody else's fund at 2% return, you would have become poorer. This is not, we don't need to get into higher mathematics.
Let's watch Terry explain why the math works.
Don't take my word for it. This is Warren Buffett's sidekick, Charlie Munger. I don't know why he picked these particular numbers, but this is what he said. Over the long term, it's hard for a stock to earn a much better return than the business which underlies it earns. If the business earns 6% on capital, this is the return on capital again, over 40 years, I have no idea why he chose 6% in 40 years, but it doesn't matter. You hold it for that 40 years, you're not going to make much different than a 6% return. Here's the punchline, even if you originally buy it at a huge discount. Right? Conversely, if a business earns 18% on capital over 20 or 30 years, even if you pay an expensive looking price, there's the punchline the other way, you'll end up with one hell of a result. Right? Now, Mr. Munger is not speculating on this. He's not offering you his suggestion. It's mathematically a fact. Right? Here's two companies, and your investing career, 40 years, seems like a long time, but actually most of us, given our lifespan now, are going to be investors for much longer than 40 years. Actually, even if we start in our 30s, say, we're going to be investors for much longer than that. And these two companies are, you've got a very simple choice. You've just got to own company A or company B for the 40 years. That's all it is. That's all you're required. Company A has a return on capital employed of 20% and B has one of 10%. On the day when you go to buy them, they are differently rated. A is trading on 4 times book value on the stock market. B is only 2 times book value. For those of you who are not analysts, book value is the capital, take it as the capital employed there. So for every pound of capital employed in this lovely 20% earning company, you've got to pay 4 in share price terms. Whereas unsurprisingly, with this one only makes 10%, you've only got to pay 2. Bit trickier, isn't it? Which one do you want now? It gets worse. When you come to sell them 40 years later, because you want to invest in bonds and lose money, this one has halved in valuation. I have no idea why it's occurred. It's out of fashion. Your timing is bad. For whatever reason, just take my word for it, it's happened. It's gone from £4 for every pound of book value to £2. This one, conversely, is in fashion at the moment. It's doubled its valuation. Now, which one do you want to own? It's still A.
Now, let's make it tangible. We'll compare the MSCI World Quality Index to the broad MSCI World. We see that there have been some months and years where the MSCI World does outperform the MSCI World Quality. However, looking at the long-term annualized returns since 1994, we observe that there's an over 3% annualized outperformance by the MSCI World Quality. Fewer names than the parent index, but higher average ROE, lower leverage, steadier earnings. Weights tilt towards the strongest businesses. That's the point. You don't have to pick them one by one. The MSCI World Quality ETF tilts you towards these businesses. Rules-based, semi-annual rebalance, quiet, consistent. Profitability, stability, strength. Of course, return on capital is not the only factor, and valuations do matter, especially in the short to medium term. That's why on this channel, we'll study high-quality companies, especially when sentiment turns negative. We'll ask one question: is the low valuation deserved, or is it fear and narrative? Because when the business quality is intact, but the story is broken, you get the big opportunities. We saw it with Netflix, we saw it with Meta. In 2022, their valuations fell much faster than the fundamentals. That disconnect became massive outperformance. And opportunities like this will continue to come along. In fact, there are several of them out there that I will talk about soon on this channel. If you want to take a deeper look into the MSCI World Quality Index, I've added a link to the description where you can download the fact sheet and methodology. And if you're interested in the stocks I believe will outperform significantly in the future, feel free to subscribe so you don't miss what's coming next.